Hello everyone, today we will be learning about budgeting system, and under this topic we will be looking at basic budget system concept, objectives, classification of government budget, budget balance, and fiscal year. Basic budget system concept. A budget is a tool used to plan and control the use of scarce resources, meaning it acts as a map for future economic activities, and it also aims at making optimum utilization of the capital and other resources that any agency or organizations have in hand. Budgeting is determining for a future period of time in regards to what is to be done, what is to be accomplished, the manner in which it is to be done, and the cost of doing it. In other words, budgeting integrates the processes of preparing, implementing, and operating budgets. It is prepared on the basis of past experiences and the trends in the business. Like it has already been mentioned, budgeting is used to forecast the financial position for a specific period of time, and along with the planning, it is also used to measure the performances. Therefore, a budget is a plan showing an organization's objectives and how management intends to acquire and use resources to attain those objectives. The objective of the agency should be broken down into detailed work plans so that it becomes easier to navigate through the process and also it becomes achievable. Or a budget can also be defined as a monetary definition of the future plans of the agency. The term budget means the estimates of revenues and receipts and expenditures. Therefore, in general, the budget is described as a statement that represents a financial estimate of income and expenses of the government for a certain period of time. Objectives. The principal objectives of budgeting system are to provide a framework for the assessment and allocation of resources, execution, monitoring, and evaluation of all government programs, projects, and activities, like we have already seen in the previous slide. To provide for the budgetary status of the government, meaning which will show the real financial situation of the government. To enforce or apply various means of raising revenues and receipts, and to put a limitation on the expenditure of the government funds. Classification of government budget. Government expenditures are classified into 4 categories, namely current expenditure, capital expenditure, lending, and repayment. Current expenditure. It is also known as recurring spending because these kind of expenses happen again and again. These include the purchase of goods and services for current consumption or for benefits expected to terminate within the fiscal year, or short-term expenses that will be done within a period of a year or so. This kind of expenditure has short-term effect on the economy. Example, salaries, stationeries, special allowances, travel, utilities, rental of property, maintenance of vehicles, operating expenses, interest on loans, and more. Capital expenditure. It is the expenses or spending on assets. These include the acquisition of goods and services, the benefits of which extend beyond the fiscal year and which add to the assets of the government, or this kind of expenses last for more than a year, for about 2 to 10 years. Therefore, they have lasting impact on the economy. Example, acquisition of land and buildings, land improvements, buildings and structures, equipment and tools, vehicles, and more. Lending. These include loans to individuals and organizations. Repayment. Repayment of principal amounts. Payment of interest on loans are charged to current expenditures because they are recurring expenses. Government receipts are classified broadly as taxes and duties, fees and income from property and enterprises, proceeds from sale of land and other capital assets, recovery of on lending, grants from multilateral and bilateral sources, borrowings, and receipts from other sources. Budget balance. Overall budget balance is defined in 2 ways. 1. Budget deficit or surplus. Budget deficit or surplus is equal to total income minus total expenses. A budget deficit is the amount by which expenses exceed income. Deficits are financed by borrowing. In other words, if the total income is higher than the total expenses, then it would be budget surplus. On the other hand, when the total income is less than the total expenses, it is known as budget deficit. And this can be rectified by either borrowing or increasing the total income of the organization. A budget surplus is when income exceeds expenses. It can be used to pay off the debts. Income or revenue can come from taxes, fees and income from property and enterprises, proceeds from sale of land and other capital assets, recovering of on lendings, grants, and project-tied borrowings. Expenses include current expenditures, capital expenditures, lending and repayment of the borrowed money. 2. Fiscal deficit or surplus. Fiscal deficit or surplus is equal to income minus expenses. Here, income also includes the revenues from taxes, fees and income from property and enterprises, proceeds from sale of land and other capital assets, recovery of on lendings and grants. Expenses include current expenditures, capital expenditures, and lending. The main difference between the budget deficit or surplus and fiscal deficit or surplus is the inclusion of project-tied borrowing and repayment in the budget income and expenses respectively. Fiscal year. The fiscal year is the government's accounting period. It starts from 1st of July to 30th of June. The budgets are closed on 30th of June. Therefore, any unutilized balances of appropriations at the end of a fiscal year shall automatically lapse, meaning any agency or government organization is unable to utilize the money that has been authorized or allocated to be used within an accounting period, then the budget will automatically become invalid.